Hello again. This is now a chapter on tax exemptions and their treatment in value-added tax. Well, let's have a look. First, we are going to talk a bit about the economic consequences of tax exemptions under VAT law. Then, after that, we can understand why there is the possibility to opt for tax liability, so to renounce on several tax exemptions. And we have also to speak a bit about the treatment of input tax in case where an input is partly used to produce tax exempt and partly for to produce tax liable output. A remark on the interpretation and application of tax exemptions will close the chapter. Well, so let's begin at the beginning. VAT law has a simple rule which does not always apply, but in most cases, so it's a kind of basic or general rule. The rule is simple: who does not have to pay VAT on an output also has no right to deduct or get refunded the VAT which was included in the prices for the input. So, no output VAT means also for yourself no input VAT. So you either have to pay and get a refund for the VAT in your cost, or you lose both. That principle can in German law be found in 15.2 number 1 USDG, or in the VAT directive you find it indirectly in the articles 168 and 169, where you can clearly see that input tax refund or input tax deduction is only granted for output which is liable to tax. Well, that means when we look to the economic consequences of a tax exemption, whoever gets a tax exemption loses also the claims for input tax deduction for all the input related to that tax-free output. That means the VAT in the input becomes then definitive and will get a cost character for that enterprise. So in the final effect, the VAT exemption for your output decreases your costs, but the VAT treatment of your input increases your costs. And so finally, in the total effect, only your own profit margin or your own margin between input and output is left free of VAT. Yeah? So that means only your own contribution to the economic production is left free. The VAT of the producers before you in the chain of entrepreneurs becomes definitive. That also has as a consequence that an exemption is not always a positive thing. For example, if your input tax claim is higher than your output tax claim, then being exempt is a very negative thing. You lose money. For example, that could be the case if you have big investments and you have only a small output, and that output is then tax-free. Then all your input tax turns into cost, and that's not always a favorable thing. Also, in cases where you are in a very bad economic situation, for example, that your output turnover is lower than your costs for the input, which would indeed be a very grave and negative situation, then no chance. If you are tax-free, then the input tax becomes costs. Also, economically, you simply lose money from a tax exemption if you have a customer who is, in his or her turn, also an entrepreneur, would get the VAT in your price back as input tax, and therefore does not care at all if you charge him or her a net price, or a net price plus VAT. In such a situation, having to charge a net price because of a tax exemption really entails an economic disadvantage for you, because had you been able to deliver in a tax liable way, then you would have regained the input tax. Now, in this specific situation, due to the exemption, you lose it, although the economic outcome on the output side would have been the same for you and your customer. So an exemption can have negative effects. So that's the general principle. No output tax, no input tax refund. Only a few exceptions exist where the output remains tax-free, but nevertheless you get or you can keep the input tax. That is mostly the case in export situations. So where the transaction which you do is related to some export. The reason for this treatment is that if VAT becomes a part of the cost of the output which is exported, then that increases the minimum price of our supplier in the foreign market. So VAT drives up the costs, and that means our supplier will no longer be able to be competitive in the foreign market. And in case of an export, what you deem to be or what you regard as a tax exemption under the German perspective is not really a complete tax exemption, because the goods which you deliver to the foreign country will be fully taxed in the foreign country. So it is even adequate to free them of input tax, even under our fundamental principle that no output tax, then no input tax, because there will be a tax on the output, although it will be in a different country. So in that case, turning the input into the input tax into cost would entail a double taxation and would violate the principle of country of destination taxation. So that's why in case of exports, one usually renounces on canceling the input tax refund. But in all the other cases where the output is tax-free, it may be that the input tax, or it will be usually that the input tax refund is lost, and that you have to probably face a negative effect. Let's mention again the two cases where that plays a role. First, if your input tax is higher than your output tax due to specific circumstances, or if it would not matter if you increase the price to your customer by the VAT, so that for you and for your customer it plays no role if you charge them a net price or net price plus VAT. Yeah. Now imagine that you are exempt, but your customer is also a member of also somebody in the chain of entrepreneurs, also a business owner. Then it would even end up with the consequence that VAT within the chain of entrepreneurs would become definitive, and that could lead to a distortion of competition to the disfavor, to the disadvantage of the persons to which you grant the exemption, and that would be completely contradictory. So here I laid down an example. E1 produces something for cost of 100 and sells this for 119. E2 now shall be tax exempt, for example, because the legislator wants to do him a favor or her a favor, because E2 is blind, for example. There is a tax exemption in German for number 19 for blind entrepreneurs who have not more than 2 employees, so small blind entrepreneurs. Now E2 has costs of 100 for own labor or something else, plus his or her raw material cost of 119 from the purchase made from E1. So we end up with total costs of 219 because E2 does not get a refund for the 19 VAT in his or her raw material costs. So the costs for the next in the chain. Well, E2 can only sell for a price of 219, so E3 has then 100 own cost again, and the cost calculation for E3 will be 100 plus 219 from the service or good purchased from E2. So E3's minimum price is now 319 plus VAT. If we compare that to a chain of entrepreneurs where nobody is blind and nobody gets a tax exemption, they would be able to offer the final product for 300 plus 19%, so far cheaper. And that would show that in that case we have a contradictory effect. The tax exemption works to the disadvantage of the person which it should protect and support. And the second, theoretically also very interesting aspect is that in that case, VAT becomes definitive in the chain of entrepreneurs. That's also something which should not be and should not happen. So one should think about if it's not recommendable to remove that effect. But how can that be done? And the solution or the approach which the law chooses is relatively simple. It allows E2 to renounce on the tax exemption if E2 thinks that appropriate, but only in cases where the tax exemption may lead to an inadequate effect. So if the customer of E2 is again an entrepreneur, E3, and not if the customer is a private consumer, because if the customer is a private consumer, then letting the margin of E2 tax-free always means either an advantage for E2 because E2 can keep more for himself of the gross price, or an advantage for E2 because E2 can offer a lower gross price than under other circumstances. So only in the case where we have VAT becoming definitive within the chain of entrepreneurs, and there is again an entrepreneur as customer, the law regards it as necessary and adequate to offer the option to renounce on a tax exemption. Now, you must know that the option to renounce on a tax exemption is naturally something strange, and people will only renounce on such a tax exemption if it is financially in their favor. And that is the reason why naturally, on the other hand, the law says you are only allowed to renounce on a tax exemption if that is explicitly allowed and if you fulfill certain conditions. So there are many tax exemptions, to be clear, most of them, where the law does not or never allow you to renounce on. But if you find you do one of the activities which are on a certain list, you can renounce on that exemption if you regard that as adequate. Now here the European Union law says if a member state allows an option for tax liability, they can only allow that if the exemption is one of a certain list. But if they allow their taxpayers to renounce, then they can determine the conditions under which they allow such an option. There is one of the rare cases where you have, concerning the details, differences between the law of different EU member states. Now, in Germany, for example, the paragraph 9, section 1 USDG contains a list of the very few tax exemptions on which you can renounce as an entrepreneur. And paragraphs 9.2 and 9.3 then contain additional requirements for some of these options, especially for renouncing on the tax exemption for letting a room or a building or a piece of land for rent to another entrepreneur. Because in former times, before these additional conditions were made, several intelligent and clever people set up very interesting tax-saving models, which led to the complete refund of all the VAT and the costs for a new building, and then only entailed the obligation to pay a very, very small amount of VAT on the rent paid every month. And that led to grave consequences and to big financial outflows from the ministry to the industry. And so they tried to block this and to restrict it to all those situations where also the person who rented the building would have an immediate claim for refund of the VAT and the building costs. Well, but that's rather technical. What you want to know and need to know is simply if there is a tax exemption, you will have to check on the next step if one can renounce on that. So check the conditions in paragraph 9 and if that is recommendable. So just to underline it again, in EU law you find that in Article 137, and that allows certain differences between the transformation of that basic rule in the member states. Yeah. Now, naturally, you will ask yourself, how do I opt for tax liability? And the answer is you opt for tax liability or tax exemption if you are allowed to in each individual case. So just, by the way, how you write the invoice. Where options are allowed, the entrepreneur can opt in or opt out of tax liability for every single transaction, just depending on the individual circumstances. So the natural consequence of an option to tax liability is then, as the output is no longer tax-free, the input tax can now be claimed. And that is naturally why people opt. This is the advantage which you want to secure to yourself. Now, just to illustrate the consequences, let's have a look on the situation again of entrepreneur 1, 2, and 3 in the previous example, where E2 was blind and therefore tax exempt with all his revenue. E1 has again costs of 100, is not tax-free, sells for 119. E2 blind has own costs of 100. Now E2 renounces on the tax exemption for the transaction which E2 makes with E3, his own customer. So as E2 has renounced the tax exemption, he now has liable output, and that entitles E2 to the VAT input tax deduction. So the cost for the raw material go down from 119 to 100. The total cost for E2 goes down to 200 instead of 219 in the previous example. And so E2 can now sell for 238, 200 plus 19%. E2 now buys under the just normal consequences for 238, claims the input tax refund for 38, and the cost go down to 200 plus own cost of 100, and so on. So E3 can then sell for a total cost of 300 plus VAT. So the distortion of competition, which was originally caused in the previous example, or in the first variant of this example, has now vanished. Now everything's fine and clear as ever. So in practice, you will probably observe that E2, if he or she is really blind, will usually renounce on the tax exemption for all transactions done with business customers, whereas if E2 works for private consumers, an option will not be allowed, and in that case it will always be in favor of E2, because then E2 can either keep more of the gross price or can offer for a lower gross price due to the missing VAT obligation on the output price. Well, where are options for tax liability possible for under German law? There is for number 8, certain financial transaction. For example, giving somebody a credit in return for interest is a service if it's done by a bank or by an enterprise. But you have probably never seen that a bank charged you VAT on the interest for a credit which the bank gave you. Indeed, certain financial transactions like giving credits for interest in return are tax-free. Now, if a bank gives a credit to a business customer, for the business customer that then plays no role, because that business customer could reclaim the VAT on the interest. And so the tax exemption makes no sense, but rather would do some damage, because if the bank has to give the credit tax-free to the other business, then the bank loses input tax claims, and so the costs for that credit would go up, and that would have rather some inappropriate effects. So we allow the banks to opt for tax liability in cases where they give a credit to a business customer. Probably you have seen, or you will see when you apply, or if you ever apply for credit from a bank, that the bank will try to ask you if you use that credit as a private person or for business purposes. Usually their general conditions for business customers are different from the conditions for private customers, and here is one of the reasons for that. For number 9, the tax exemption for selling buildings, pieces of land, and so on. Usually these things are free from VAT, but you can opt for tax liability if your customer in turn is again a business, and so could probably get the output tax back, so that a tax exemption makes no sense but would only result in financial damage for the tax-free person. For number 12a, letting buildings, pieces of land, and so for rent to somebody else is also tax-free. You can again opt out of the exemption and opt for tax liability under the conditions that the customer is also an entrepreneur and fulfills some other conditions. For number 13 is rather a peculiarity, rather rare case, forget about that. And for number 19 is the last and most strange example, the tax exemption for blind people in German law, which is, I believe, not known in many other member states. It goes back to, I think, the period after World War I, when one wanted to subsidize people who had badly been hurt in World War I, but one wanted to give them in this way a kind of a financial support to have more success with independent economic activity. And that exemption has never been abolished since then, and was probably taken over, or it was allowed to continue that exemption by the European Union when the VAT directive was negotiated. In real life, probably nothing of great importance, but always good for constructing nice and impressing examples. Remember, please, that the exemption, or renouncing on the tax exemption is always, in all those cases, only possible if also the customer is an entrepreneur. So you can never renounce on a tax exemption when you do business with a private person. So you will probably then see that people operating in these parts of the economy usually try to find out if they are just doing business with a private or a business customer. Natural thing. Which consequences can that have for input tax? The best way to illustrate that is to think about the situation where you have a house with several floors and rent it to several people. Then we can form an idea how that can be treated, what is taxable, what or liable to tax, and what is not. And then naturally we can afterwards conclude how much of the input tax you can save for yourself by cleverly renouncing on exemptions. Well, let's look to the case data. You have a house plus piece of land in Düsseldorf, and you sell it to another entrepreneur for a price of 500,000. The buyer has a business where his only output is fully taxable and entitles to input tax deduction. Translation: the buyer does not care at all if you charge him or her 500,000 plus VAT, which he will get back, or if you charge him or her 500,000 flat. So the buyer, if you say, I want to opt for tax liability and then charge you 595,000, the buyer will just say, doesn't matter for me. So the seller wants now to opt for tax liability because the seller has still some input tax problems connected with the building, so that selling the building tax-free would ruin that input tax refund claim, which is still pending. So, is it possible? Let's test the situation. First, as you have heard in one of the previous lectures, it is never allowed just to jump to the question. We have to begin at the beginning, so to test taxability. So we have to test number one. R, the seller is an entrepreneur under the rules of 2.1 ESDG. R acts within the scope of his enterprise because it is enterprise property what is sold here, 2.1 sentence 2. It is sold for consideration because R requires a price. The transaction is a delivery because a tangible good is sold, and the selling means ownership changes, or economic ownership. The position, like an owner, changes. It's transferred to a new person. The place of delivery is to be determined under the rules. You can't guess it, you know that. The rules in question are either 3.6 or 3.7, depending on if the good in question is moved during the transaction or not. And it seems to be very clear that houses, when sold, are not moved from one location to the other one. So 3.7 applies the rule for transactions without movement of the good. That rule says the place of delivery is where the good is at the moment when ownership is transferred. So that's Düsseldorf. Düsseldorf is in the inland under the rules of 1.2 sentence 1 because it's neither Heligoland nor Büsingen nor on the high sea. So all the 5 conditions for taxability are fulfilled. The transaction is taxable. Now we come to step number 2. Is there an exemption or is it liable to tax? And here we find the exemption of 4, number 9, letter A, USDG, tax-free are all transactions which are covered by Real Estate Tax Act, the German Grunderwerbsteuergesetz. So if a piece of land or a building is sold, then it's covered by the scope of another tax, and then it's automatically free from VAT because that has been agreed so between all member states of the EU in the VAT directive. So we have a tax-free sale. And now the next question is, can R renounce on the tax exemption? Let's first test 9.1 USDG. 9.1 USDG requires that the customer also is an entrepreneur, that's the case, buys for his enterprise. Yes, that's true. The only additional requirement for opting for tax liability in case of selling a piece of land or selling a building is laid down in 9 section 3. You have to inform the buyer of your decision to opt for tax liability at latest in the contract before the notary, so that the buyer cannot be surprised by the final effect that the price raises up to a gross price. Well, R made use of that option, so then the sale is now liable to tax, and R can keep all the input tax related to the building which is sold from the last month or even the last 10 years without enormous problems. Good. So there is also a constellation where, or there will be the problem that sometimes one and the same input is used to produce several outputs. You know that if you buy a machine, not only one item will be produced. If you have a building, for example, a house with several floors, it might be that the one floor is rented out to somebody for whom you can opt to tax liability and the other floor is not. And now if you have the building painted, the costs relate to both floors, and so you have to decide what then happens to the input tax deduction. And VAT law just decides this according to the principles of cost calculation or cost accounting. You just say, well, the input has to be attributed to that output to which it economically refers. So if you use painting of a facade for 2 floors, of which one is rented out liable to tax and the other one is rented out free of tax, then, well, the painting costs for the house facade will refer 50% to the tax-free floor and 50% to the liable floor, and that in turn ends up with the logical conclusion. 50% of the input tax from painting the facade will be deductible and 50% will be not. So if you have a mixed use of an input, then you have just to attribute the input VAT partly to the tax-free output and partly for the output which is liable to tax. One can also explain that with a rather long example. Here we have it, and as that is a bit long, let's try to first describe the situation. First floor is the ground floor. The ground floor is used by the house owner for his own business. The first floor is then let to a customer. Sorry, not to a customer. Old age, ladies and gentlemen. Sorry, I was a bit distracted. Probably you are also from time to time. I can only apologize. So, first floor is let to somebody who is a private tenant and lives there. Second floor is rented out to a private detective. And the third floor is where the house owner has his private habitation. And then you have now to find out what happens to the input tax for the building cost of the house or something like that. So let's think about how that shall be done. So let's think about the situation again. Ground floor was used by house owner for his own business, and let's assume that business has tax liable output. Then there is no output in using the room. This room is just used for an own business, and if the own business does transactions which entitle to input tax deduction, this should be fully deductible. The first floor is rented to a private person. Now let's think about how that will be treated. It is a service under Section 3.9 to let a room for rent. The place of the service is where the immovable property is located, that is here in our example in Kleve in Germany, under the special rule of 3A3 number 1 USDG, where the building or piece of land is located. This rule is a special rule deviating from the basic rules for places of services, but we will probably have to talk about this in a later lecture. Well, now Kleve is in the inland 1.2 sentence 1 USDG. So, as also the other three conditions for taxability are fulfilled: entrepreneur, scope of enterprise, and consideration, letting the first floor for rent is taxable. That raises the question if it is exempt or not, and under 4 number 12 letter A, letting a building or a piece of land for rent is always tax-free. Now, if you want to get rid of the tax exemption in order to recover input tax, is that allowed to renounce on the tax exemption? So we have to check 9 USDG. The first subparagraph or section of 9.1 says you cannot opt for tax liability because you can only opt if your customer is an entrepreneur and a private person living in the first floor for his or her private life is not an entrepreneur. You can't renounce, so it remains tax-free. You can't charge VAT, so you can never get back the input tax relating to everything which has to do with letting the first floor to rent. Second floor, taxability, just as before, it's a service. The service has its place of service at Kleve. All the rest is fulfilled, so it's taxable. 4 number 12A says letting rooms for rent is tax-free. Can you now renounce on the tax exemption? You have again to check 9.1. Now, second floor was rented out to a private detective. And although the word private detective nicely confuses you by the signal word private, a private detective is if independently acting. So if his own boss is an entrepreneur. So you could fulfill 9.1. And 9.2 says the option in cases of 4 number 12 is only allowed by Germany if the person who rents the rooms only has own output which is fully liable to tax. And in case of a private detective, let's assume he is not blind, then we always have liable output. There is no tax exemption for such strange people as private detectives. You can easily memorize that. You never saw a crime story where the private detective said to his customer, "My fee will be 1,000, but it will be free of VAT." I do not know a single crime story where a private detective tried to comfort his customer by this phrase, and as you also will never have seen such a crime story with that nice little remark, we can be safe and sure and certain that there is no tax exemption for private detectives. So we can opt for tax liability because we have a tenant who is an entrepreneur and also has liable output. Third floor is used by house owner himself, so no transaction, just a use for non-entrepreneurial purposes. So there will be no option possible because the house owner as a private person is not a contract partner for which you could opt for tax liability. The private part of the house owner's soul can never be an entrepreneurial customer. So, to sum that up, how does the whole situation look like? Well, ground floor used for own business, first floor private tenant, so tax-free. Second floor private detective, liable to tax if you want so. And top floor private usage again. So we have here 2 floors which can be rented out liable to tax, and 2 floors which can't, and that means if you look to the input tax situation, then if, let's say, you have the facade of that building painted, then the cost of the facade refer to the whole building, so they have to split up according to economic keys or to the established principles of cost accounting. In that case, if all the 4 floors have the same measurements, then it is a reasonable assumption that 1/4 of all the costs refers to each floor. So we have 1 floor with taxable output, 1 floor used for the own taxable business activities, and 2 floors which do not entitle to input tax because they are either not taxable at all or liable to free from tax. And that leads to the nice conclusion that half of all the input tax in this situation is deductible and half of it is not. If an input is used partly for tax-free output and partly for an output which is liable to tax, then we have already understood, then you have to split up the input tax according to principles of cost accounting and to attribute a part of that input tax to the tax-free output and another part to the tax liable output. Now the question is, by which rules or by which principles do you have to do this? Under EU law, 2 methods are allowed. EU law first allows you the very, very clumsy approach to attribute the costs to the output according to the ratio between the 2 outputs. So if the first floor is rented out for 20,000 euro and the second floor is rented out for 40,000 euro, then the pro rata method would allow you to split up the input between the 2 floors in the relation or in the ratio of 2 versus 4. So you just look to the relationship between the turnovers which you produce. Now, every good cost accountant would tell you that's rubbish. That's a very simple approach, but it does not reflect the economic situation, because it's not plausible that the costs have been caused, have their origin just according to this. It's far more plausible that there will be other potential keys according to which you can attribute the costs as or according to the relation in which they have been caused by the 2 things. For example, as I already mentioned, if you have a house with 4 floors and they are all equal, then naturally all the costs relating to the complete house will be, by a reasonable accountant, attributed to each of the floors alike. So you try, this is the second method allowed by the EU. The member states can prescribe their taxpayers to attribute the cost according to the economic causes. This is, by the way, the only method which Germany has opted for. We have explicitly forbidden to use the pro rata method in all cases where a better attribution of the input tax costs can be found, and that is nearly always the case. Other states rather are fans of that rather superficial pro rata method, so sometimes you will read in literature on foreign VAT legislation that the pro rata percentage for a year has to be determined and later to be checked. That is something which a German tax expert usually cannot understand, because here in Germany we have only the second method. You have to attribute the input tax in cases of mixed output to the different outputs according to established principles of cost accounting. So according to their economic causes. In 15.4 USDG, you can explicitly find the rule which forbids to use the pro rata method in all other cases where a better attribution can be found. By the way, it may also be because the input tax claim is brought forward at the moment when you pay the input tax. You get it directly refunded. Now, in case of usage for tax-free output, or in case of usage for mixed output, the problem is when you buy the input, the output is still in the future. So you can only decide about which part of the input tax you are entitled to claim. You can only decide about that on the basis of a prognosis. You can only estimate what will happen. Now, it might be that later the actual use of the input goods or services deviates, so is different from that which was planned in the beginning and was regarded as true at the moment when you claimed input tax. That can entail later a correction of the original input tax claim, and that indeed can happen during a period of up to 10 or even in some member states 20 years after the input tax has first been claimed. But that is also a relatively complicated topic, so we shall discuss that later in one of the chapters at the end of the semester, at least I hope so. Yeah, so that's nearly everything which we have to say here. A last warning which you about something which you should have already heard and understood, that tax exemptions are an exception from a general and fair and just rule, so they are interpreted in a narrow sense. That means where the wording of the law and the context does not really force us to regard something as tax exempt, it is not tax exempt. What is not clearly mentioned as exempt in the law is not exempt. So it is not sufficient that you do something which is similar to something on the list. You have to do something which is really on the list of tax exemptions in order to be tax exempt. So that's the case, and everything so what is not exempt but taxable will also automatically be liable to tax. In practice, that means, for example, if you are an insurance agent, brokering insurance contracts is tax-free, but if you do something which is only similar, that's not tax-free. Or if you are a medical doctor, not for dogs and cats, but for humans, then everything which you do, every health treatment or health care for humans is tax-free. But now, if for a life insurance contract or for a social security matter, you have just to give a professional opinion of the state of health of a person, there will be a surprise. What you get paid for that service is not exempt from tax, because it's no healthcare activity if you just watch a person, have a look on him or her, and then give an opinion without any attempt to improve that person's health situation. Health treatment for humans is only a treatment which has the aim to better the health situation of the person in play, either by removal of the disease or by soothing down of pain or something else, and improving the financial situation of that person by writing a professional opinion and convincing a health insurance company or a life insurance company, or convincing an authority to accept some proposal from the person in question. So attempts to improve the financial situation of a person are not health treatment, although we would all probably greatly appreciate that. So not tax-free, even if it's done by a doctor. And that is very often a surprise for certain professionals, because they just think everything I do, my activity, is tax-free. But, well, if they deviate from the standard activity, probably that's no longer covered by the wording of the law and the sense of the law. And so, surprised, they end up with something which is also liable to tax. Yo. And this, ladies and gentlemen, was everything which I had to tell you on tax exemptions. So, just to sum it up, there are some tax exemptions. There is a list in paragraph 4 USDG. Every tax exemption also, or nearly all of them, only the exports are an exception. Nearly all exemptions entail the negative consequences that you lose the correlated input tax refund. And that makes a tax exemption something which is not always a positive thing. So the law gives you sometimes an option to renounce on the tax exemption. When you work on a case, you must know one thing: you can only test if somebody can renounce on an exemption if you first have proven that that person has a right to that exemption, because you cannot renounce on something which you don't have. That's very much important if you deal with a case. So first check the exemption, afterwards check the option. If already the exemption fails, it would be horrendous to speak about renouncing on that exemption. Yeah, and naturally, exemptions have to be interpreted in a narrow sense, so what is not really and clearly exempt will automatically be liable to tax if we have to do with a taxable transaction. Good. That shall be enough for this time. Thanks for watching again. Hope you survived this small video again. Yeah, in a reasonable condition. Recover well and come back for the next video. Thanks for watching. Till later.